Hi, and welcome back to the weekly market update from Morton Brown Family Wealth. I'm Dennis Morton here with Katie Brown and Cody Demmel. How are you guys?
Good.
Good.
Good. Good. All right, so we're the week of May 18th, and we're going to talk about a couple of things today. First is the 4% rule, the withdrawal rate that we have supposed was right for taking retirement distributions and why it might not be right anymore. Second, we're going to look at a post from one of our favorite writers, Ben Carlson, at A Wealth of Common Sense, where he talks about low bond yields and what that means for investors. And then another piece from Ben, which Cody pulled forward, about how sometimes the strongest stocks in the stock market don't always have the best performance. All right, guys, let's start on the 4% rule. So this is something that, I've really liked to think about over the last few years because that is a frequent question that we get is how much can I safely take out of my investment portfolio without depleting my assets? And the 4% rule has been used to say if you take 4% or less out every year, in most cases, you will not spend down your assets. But we've always found that a little bit challenging because that assumes certain things. It assumes that you have a balance between stocks and bonds, and that your stocks are going to earn 8 to 10%, that your bonds are going to earn 3 to 5%, and your cash is going to earn 2 to 3. What the challenge is what happens when your cash is earning 0, your bonds are earning 2 or less, and the stock market is collapsing at the same time. That changes the math a little bit, and that's what this article brought up. And I thought it was very interesting that the author said, really you should be maybe thinking about anywhere from maybe a 2.5% withdrawal rate, or maybe some other strategies to add some more security to your income streams. He got into things like annuities or working longer or some other strategies there, but it brought up some interesting planning considerations. Katie, what did you see in that article that caught your eye?
Yeah, there were a couple of things that really kind of pulled me into the article. Just the reminder that making a decision around retirement is not solely based on how much money do I have in my account. It's really taking into account what it all is on your balance sheet. Where do you have levers? How can you manage your assets and your liabilities? And remembering to not discount things like Social Security, and how making a good decision around Social Security and when to take that will impact your entire retirement. And so I think that's a really important takeaway. The other thing that I really appreciate about the article too is they made mention, take this as an opportunity right now to practice retirement. You're at home a lot, you're spending time with your family, and you're really limited as far as where you can spend money. So you start to figure out, where do I need to spend money? Where do I want to spend money? And just, I think it is good practice ground before heading into that large decision.
What did you see in that article, Cody?
Yeah, I thought that was a very good article that Dennis brought forward. One of the things that I thought was very interesting was the Affordability Index. It's actually at the lowest it's ever been, and the article goes back to 1980. Right now, there's only a 30% affordability index, which is pretty concerning, but that's also one of the reasons why we like to do financial plans for all our clients. And I thought that was a great piece of the article.
Yeah, and I think coming back to just the whole idea of a 4% rule is that at times like this really isn't the time for rules. There's a lot of guidelines. And then if you try and be hard and fast in things, you can get tripped up because you overcommit to a particular strategy when flexibility is really what's needed. So I prefer kind of a percentage guideline than a rule, because you have to reevaluate it based on the conditions on the ground. So tying into that, Katie, you found that article from Ben Carlson about low interest rates, how they're not unusual, but there's other things that we need to be worried about. What'd you hear?
Yeah. So, and that does tie in really well, because typically as people near retirement, or if they have other risk factors, they might be building in more fixed income, things that are potentially a little bit more secure. But that security, the interest rates on bonds have come down significantly over the past number of years, and they're probably going to be low for a while. One of the things, though, I thought was interesting about the article, because it was talking about how we've had actually in an environment where interest rates are coming down and inflation is coming down, it actually creates a magical bull market for bonds because then prices go up significantly. But now we're at lower yields, but it brought up the point that interest rates will impact bonds to a degree, but really it's inflation that we need to watch. And you have to watch when those lines cross. But if inflation stays intact and it doesn't run away from us, then you can still get decent returns on bonds, even if we're in a low interest rate environment. But that does play into the 4% rule too.
Right.
Yep.
You think about the 1970s being a period of, higher bond yields and everything else. But when that chart they showed of real returns, once you factor in inflation, returns were actually negative in the 70s. It just becomes that much harder to keep up. And I like that idea of, real returns, the returns you can eat. You have to be able to, actually go out and have purchasing power. And if your bonds don't keep up, then you're losing ground.
Exactly. And I think that's overlooked oftentimes. People are very focused on, well, what is the yield of the bond? And sometimes overlook where inflation rates are at, because once again, if those lines cross, then you're not getting nearly as much value out of them as you may have thought.
Mm-hmm. Mm-hmm. What did you see on that, Cody?
Yeah, pretty much that exact same thing. It went over the total returns from energy and technology. So from 1999 to 2013, energy returned 385%. Technology only returned 29%. Everyone knows how that has been recently. From 2013 till now, energy is actually negative 49%, and technology is up 180%. This is just one of the examples of why we want to have diversification throughout our portfolios.
And you know what I think is such a good thing to remember, because we're looking across investment portfolios, and you are seeing long periods of underperformance, whether it's energy or value stocks or anything else. Just think over the last 20 years, if the theme has been technology has taken over the market, whether you're Amazon or Microsoft or Google, that taking over of the world started with 14 years of underperformance by 300%. And only in those last few years that you took off. So that's a lot of patience. That's a lot of, not buying into the hype, not chasing things in order to get those world-beating returns. And they show that historically that has been the case. I mean, all of those, there's some famous names going back. Kate, did you see some of those names that were in the chart that Ben had pulled forward there?
Yeah. I mean, AT&T led the charge for a really long time. GE, I mean, the 90s and 2000s. And they were one of the largest companies in the S&P 500. I think something else that was interesting right along those lines is they noted and they demonstrated that going back to the 70s, the S&P 500 was actually a lot more concentrated than it is now, and that turnover of the leader is happening more often than it did before. I mean, there were large periods of time where you had one company as the largest company, year after year. So
I think it's a good reminder, as conditions have changed so dramatically from what they were in mid-February to what they are now, and hopefully to what they are to the better side later on down this year or next year, that the conditions of today are never the conditions permanently. There's always going to be change. And again, not committing to one particular outcome, but accepting that change can happen, under the surface before it becomes manifest to all of us, right?
Mm-hmm.
Yeah.
I think it ties right into, was it last week? Did we talk about recency bias last week? It ties right into that and in the thought process of technology is going to lead the charge, because it has for the past decade, and maybe it will for a while longer, but we always have to remember that's not always going to be the case. And we can go through large periods of time where something is the leader and it flips right around.
That's right.
Yeah.
Great. Well, some great articles this week. We'll be sure to post those along with this video. Hope everyone has a great weekend, and let us know if there's anything you'd like to hear us talk about in the future. You can reach us at www.mortonbrownfw.com. Take care. We'll see you guys soon.
Thank you.